Hi friends, today we will be going through the US-Israel-Iran war and how India has successfully managed the West Asian crisis so far. Currently, the ceasefire, Mr. Donald Trump has extended the ceasefire, and let us see what India is doing. US President Donald Trump has extended the ceasefire with Iran that leaves some room for negotiation and ultimately ending the war. As things currently stand, the US is continuing its blockade of the Strait of Hormuz. Meanwhile, Israel and Lebanon started engaging diplomatically. But the world knows that such arrangements are fragile. What is needed right now is an early resolution. The sooner, the better. India is particularly affected due to this war. India and West Asia have a special relationship as we have already discussed in the previous videos. West Asia accounts for 50% of India's imports of crude oil, 2/5 of the inward remittances, and 1/6 of the exports. Recently, RBI has placed some restrictions on the financial institutions on trading currency derivatives, but RBI has rolled back such restrictions this week. What are these restrictions? How does this work? Again, we have discussed in another video. The link is in the top. What RBI is trying to say through this rollback of restriction is that it does not intervene in the currency market unnecessarily with the aim of pegging the INR to any particular USD value. Instead, it intervenes in the market only to contain excess volatility, which it has successfully reduced. In fact, the RBI is allowing a gradual rupee depreciation, which is warranted. Why depreciation of INR is good in a sense? India faces a current account deficit within its balance of payment. We have discussed in the previous videos. When rupee depreciates, exports become cheaper and people export more from India. So India will have a current account surplus. Meanwhile, people who settle outside India send more dollars back home to take advantage of the depreciating rupee. This rectifies the balance of payment issue in the long run. Within India, the war is affecting inflation and growth outcomes. So far, government has prevented the increased oil prices from affecting common man. But if the conflict prolongs, the government will let the oil companies increase the prices. This can have first round effect and second round effect. First round effect means there are direct effects visible from the first days of the war. Example, increase in the oil prices globally will lead to an increase in the fuel price at our local fuel pumps. RBI usually ignores this as this is temporary, but second round effect is serious and RBI takes note of this very seriously. There are indirect effects that happen if the war prolongs for longer than expected. If the increase in the petrol price that happened due to the first round effect is persisting, then common man demands wage increase. When wages increase, companies increase the price of its products and services. This again affects common man who again demands wage increase. So that leads to a wage price spiral. People assume that high inflation is normal and that will be embedded in their expectation. So RBI monitors the wage data closely to because this is a serious effect. The best defense against this kind of second round effect is anchoring the inflation expectation among the household and firms. And fortunately for India, we have a rule-based monetary policy that provides credibility and regular RBI communication that reassures markets and households, keeping inflation expectation stable despite shocks. Indian government and RBI have managed the crisis admirably so far, shielding the economy from major financial turbulence, but a prolonged conflict will test their resilience, pushing reserves, inflation control, and policy credibility to the limit. Thank you.